what if the global economy isn't, this massive, complicated machine run by perfectly rational human beings?
Right, which is how we're always taught to look at it.
Exactly. But what if, instead, you look at the economy and picture a sealed jar of hyperactive gas molecules, just constantly, chaotically colliding into one another?
It's a completely different paradigm.
Yeah, and what if those random chaotic collisions actually prove that extreme wealth inequality is, well, it's just an inevitable law of physics?
That perspective really, it completely shatters the fundamental assumption we've built our entire financial system on.
It really does.
Because we are so used to thinking of economics as this system of mechanical precision, right? Where everyone makes these calculated decisions to maximize their own profit.
The perfectly rational consumer.
Right. But shifting to a system of kinetic chaos means throwing out the idea that humans are always the rational drivers of the market.
Which is actually the perfect entry point for our deep dive today. So we are looking at Gianfranco Tusset's newly published 2026 book, The Rise of Econophysics, A Connected History of Two Disciplines.
It's a fascinating read.
It is. And our mission today is to really unpack how physicists essentially infiltrated the world of economics.
Yeah.
Because they didn't just borrow a few metaphors.
Yeah, we're about.
They applied the literal, hard mathematical laws of thermodynamics and eventually quantum mechanics to explain things like market crashes, extreme volatility, and, like we said, wealth concentration.
Yeah, and to really grasp the magnitude of what Tusset is mapping out here, we have to recognize the blind spots in traditional economics.
Right.
Traditional models are obsessed with the micro level. They zoom in on the individual agent, making this huge assumption that macroeconomic stability is just the byproduct of millions of individuals acting smartly.
Acting in their best interest.
Exactly.
Yeah.
But econophysics abandons that completely. It shifts focus to the macro level, looking at emergent properties.
Okay, let's unpack this. Because if you are out there managing a 401k or just trying to understand why your grocery bill suddenly spiked, treating the market like a predictable machine might actually be really financially dangerous.
Oh, absolutely.
So to understand why, we kind of have to go back to the turn of the 20th century. Physicists were deep into the kinetic theory of gases, so figuring out how billions of particles behave inside a closed container.
Right.
And a few of them looked at the economy and asked this seemingly absurd question: could the conservation of energy apply to money?
Yeah, they theorized this concept called the conservation of money. In physics, if you have a closed thermodynamic system, energy cannot be created or destroyed.
It just moves around.
Right. It simply transfers from one particle to another during a collision. So these early thinkers modeled economic transactions the exact same way.
That's wild.
Every time you buy a cup of coffee or, pay rent or sell a share of stock, that is a kinetic collision. The money isn't lost. It just transfers momentum from your pocket to someone else's.
Which brings up the work of Vilfredo Pareto, right? Around 1896.
Yes, Pareto is key here.
Because he looked at income distribution data across all these different countries and time periods, and he realized the numbers totally defied traditional expectations.
Completely defied them.
Income doesn't fall into a neat, symmetrical bell curve where the vast majority of people sit comfortably in the middle. Instead, it follows a strict power law. Pareto calculated a specific mathematical parameter for this, an alpha of 1.5.
And the visual shape of that alpha parameter is what really matters.
Right.
A standard bell curve implies an average, think about human height, right? Most people are around average height, and you never see a human who is 10 miles tall.
Sure.
But a power law with an alpha of 1.5 creates this highly asymmetrical shape with what we call a heavy tail.
A heavy tail. What does that look like?
Basically, a massive cluster of the population sits trapped at the very bottom, near zero, while the line stretches infinitely upward, representing a hyper-concentrated sliver of wealth at the absolute top.
Wow.
And Pareto found this exact same 1.5 curve in 19th century Italy, in feudal Europe, everywhere he looked.
Okay, let's try to visualize how the physics actually generates that heavy tail. Imagine a massive pool table, and every billiard ball represents a person in the economy.
Okay, I like this.
We start the game under completely utopian conditions. Every single ball has the exact same amount of money. Now we just let them blindly bounce around.
Just colliding.
Exactly.
Hmm.
Every time two balls collide, one wins a little money, the other loses a little. Just random coin flips. Now, you might think that random chance would keep everyone roughly equal, forming a bell curve over time.
That's the intuitive thought.
Right.
Right.
But that ignores a crucial physical constraint of the economy, which is the zero bound.
Yes, because you cannot have less than $0 in this kinetic exchange model. Zero acts as a hard reflecting floor.
Exactly. So as these balls bounce around, eventually someone hits a string of bad luck and their wealth drops to zero. They are now pinned to the bottom.
Right. They can't lose anymore, but their purchasing power is totally gone.
Yep. Meanwhile, the balls that get lucky face no upper limit. They just keep accumulating momentum. So, as more and more balls get trapped near the zero floor, absorbing tiny impacts, a few balls at the top snowball into massive economic juggernauts.
It's unavoidable.
The random collisions naturally sift the wealth upward until the entire system stabilizes into Pareto's exact 1.5 power law.
And the implication of that kinetic model is just staggering.
It really is.
Because it suggests that extreme wealth inequality is not inherently a failure of the rules or, a result of corruption or a lack of human rationality.
Right, it's just physics.
Exactly. In a closed thermodynamic system with a zero bound, an extreme concentration of wealth is the natural statistical equilibrium. It is the mathematical byproduct of repetitive exchange.
So even if we leveled the playing field,
Yeah, you could hit the reset button, redistribute all the money equally tomorrow, and the exact same power law inequality would eventually emerge just from the mechanics of trading.
that is a deeply unsettling reality to sit with. But Pareto's jar of gas only gives us a snapshot of wealth at a fixed moment. It assumes a relatively static picture.
True.
If I'm an investor, I need to know what happens when we hit play. Like, how do the prices of those assets move day to day?
And this is where the discipline had to evolve from wealth distribution to price dynamics. Louis Bachelier actually took this on in 1900.
Oh, right. Brownian motion.
Exactly. He watched the erratic, unpredictable movement of tiny particles suspended in fluid, which is Brownian motion, and mapped it onto the stock market.
Okay.
Bachelier theorized that price movements are just like those particles. They are independent, memoryless, and totally random. And when you aggregate millions of those tiny random price steps, the mathematics smooth out into a Gaussian distribution.
A normal bell curve.
A normal bell curve, yes.
Wait, okay, I have to challenge this.
Go for it.
If traditional finance builds its entire foundation on Bachelier's smooth, predictable Gaussian bell curves, aren't they deliberately blinding themselves to market crashes?
Oh, 100%.
Because a standard bell curve says a massive 20% market drop is, like, statistically impossible. It's an event that should only happen once in the lifetime of the universe.
Yep.
But anyone who has lived through 1987 or 2008 or 2020 knows the market occasionally just falls off a cliff.
And the refusal to acknowledge that flaw is exactly why traditional economics was continually blindsided by crises. The math of a bell curve is incredibly clean and easy to work with, which is why institutions loved it.
Sure, it looks great on a spreadsheet.
Exactly.
Yeah.
But it doesn't reflect reality. And that realization paved the way for Benoit Mandelbrot in the 1960s. He looked at Bachelier's neat, predictable price movements and basically said, "Your ruler is broken."
Wow.
Mandelbrot merged Pareto's asymmetrical power laws with market pricing, proving that financial markets actually possess infinite variance.
Infinite variance, meaning there is mathematically no ceiling on how chaotic or extreme a price swing can get.
Right. And to model that chaos, Mandelbrot introduced the concept of levy flights.
Right, levy flights. How does that work?
So, if Bachelier's Brownian motion is like a person taking uniform, random steps around a park, a levy flight is different. The person takes a cluster of normal short steps, but then, without any warning, they take a massive discontinuous leap miles away.
It is the mathematical equivalent of teleporting.
Yes.
Like most days, the stock market moves 0.5% up, maybe 0.25% down, normal steps. Then, out of absolutely nowhere, a stock loses 80% of its value in a millisecond.
And admitting that markets operate on levy flights forces a complete paradigm shift. Econophysics demonstrates that extreme, unpredictable turbulence isn't a glitch in the matrix.
It's the norm.
Right. It is a fundamental feature baked into the geometry of the market. The black swan event isn't an anomaly. It is just the levy flight finally executing.
Okay, but if the market has infinite variance and is prone to these wild teleportation jumps, we have a major problem. Why doesn't the entire global economy just vibrate itself into pieces?
That's the million-dollar question.
If it's just a chaotic jar of teleporting gas molecules, how does any kind of order or stability emerge?
Answering that paradox is actually what formally birthed the term econophysics in 1995, coined by H. Eugene Stanley in Kolkata.
Okay.
The discipline realized it needed to understand self-organization. Researchers at the Santa Fe Institute started looking at how complex systems manage to find stability without a central conductor. And they modeled this using something called the minority game, which originally evolved from the El Firul restaurant problem.
Oh, the premise of the minority game is fascinating.
It really is.
So imagine a market where you only win if you are in the minority. Like if everyone is buying, you only profit if you sell. If everyone is shorting a stock, you only win if you go long.
Right.
To test this, the physicists didn't use models of savvy Wall Street traders. They used what they called zero intelligence agents. Basically, algorithmic bots that just flip coins to make decisions.
And the brilliance of using zero intelligence agents is that it isolates the mechanics of the system from the psychology of the participants.
Yeah, it removes the human element.
You would assume a market full of bots, randomly guessing, would result in pure noise and immediate collapse. But it doesn't.
It actually creates a highly structured, stable market.
Right.
I was trying to map this to a daily commute.
Oh, that's a good way to look at it.
Like if I know everyone takes the highway, I take the back roads. But if everyone tries to outsmart the highway, the back roads become jammed.
Right.
So the coordination emerges naturally from everyone trying to avoid each other. It's about the constraints of the game itself.
Right.
The bots naturally fan out. They inadvertently cover all the bases.
Exactly.
The stability of the market floor doesn't come from anyone being a genius. The mathematical constraints force the bots to continuously balance each other out.
And we call that an emergent property.
Emergent property.
Right. The macro-level stability of the system is formed entirely by micro-level self-interest, even when that self-interest is executed blindly. There is no central bank or global controller actively managing the spread. The complex structure emerges organically simply because the agents are forced to interact within the same enclosed environment.
But as we get into the 2010s, the data tracking gets exponentially more sophisticated, and the econophysicists hit a wall, right?
They did.
Because modeling humans as zero-intelligence bots or independent gas molecules works for basic structure, but it ignores the reality of modern finance. People aren't isolated billiard balls. We read the news, we panic.
We check our phones.
Right. We look at what the other billiard balls are doing, and we change our behavior based on fear. So to model that kind of psychological contagion, statistical mechanics wasn't enough. They had to take a massive leap into quantum mechanics.
Yeah, treating agents as distinct, predictable entities completely fails when emotion enters the equation. So quantum econophysics steps in to treat market participants as probabilistic quanta.
Probabilistic quanta.
Yes. In classical mechanics, a billiard ball has a definite position and speed. But in quantum mechanics, a particle exists in a cloud of probabilities until it interacts with something.
Okay, that makes sense.
The state of a human trader, whether they are going to hold or panic sell, is deeply probabilistic until a market shock forces them to act.
And the craziest part of this quantum leap is how it explains market crashes through entanglement.
Yes, entanglement is crucial here.
Because in quantum physics, entanglement means two particles are linked. If you measure the spin of one, you instantly know the start of the other, even if they're light years apart. Econophysics applies this directly to the global market.
It does. The financial state of one agent instantly impacts another. Think about an index fund or a massive ETF. A tech company in California and a manufacturing firm in Germany might have zero business overlap.
Right, totally different industries.
But because they are bundled together in millions of retirement accounts, they become economically entangled.
Oh, wow.
If the tech company crashes, portfolio managers automatically sell off the German manufacturer to rebalance their risk. The panic transfers instantly across the globe.
That is terrifying. And to mathematically map that entanglement, the researchers used network analysis. The source material highlights their use of minimal spanning trees.
Minimal spanning trees.
Right. Now, if you imagine a map of the entire global financial system, it looks like a hairball of billions of overlapping connections. A minimal spanning tree is an algorithm that strips away all the noise.
It cuts right through it.
Exactly. It calculates the absolute shortest, most critical path that connects every single node in the network without any loops.
It identifies the load-bearing arteries of the economy. By mapping those minimal spanning trees, physicists aren't just looking at who owes money to whom. They are mapping the exact pathways of contagion.
The panic routes.
Right. If a housing bubble bursts, the minimal spanning tree shows you the precise mathematical route that fear will travel to infect the tech sector or the commodities market. It replaces mechanical certainty with a map of psychological and financial vulnerability.
It's like graphing the nervous system of the economy to see exactly how a pain signal travels to the brain.
That's a perfect analogy.
Which brings us perfectly into the final era covered by Tussett's book from 2018 to 2023. If the market is an entangled quantum nervous system, how do you apply these tools to the ultimate chaotic asset, cryptocurrencies?
Cryptocurrencies represent a thermodynamic stress test for econophysics. They operate outside traditional central banking structures, and they are prone to extreme sentiment-driven volatility.
Pure chaos.
Pretty much. And to decode the crypto networks, researchers utilize two heavy-hitting concepts: entropy and multifractality.
Let's tackle multifractality first, because this explains why Bitcoin charts look so erratic.
Yes, it does.
A fractal is a pattern that looks the same no matter how far you zoom in. In markets, this means the chaotic price swings you see on a 1-minute chart look identical to the chaos on a 10-year chart.
Right.
But multifractality means there isn't just one rule governing the chaos. Multiple different scaling rules are warping the asset simultaneously. The market is constantly stretching and compressing time, making those levee flights we talked about even more severe.
And the compounding turbulence of a multifractal system creates massive blind spots for investors. To measure those blind spots, econophysicists turn to entropy, specifically a model called Salis entropy.
Entropy, like ice melting.
Normally, yes, we think of entropy purely as decay. But in information theory and econophysics, entropy is a mathematical measurement of our ignorance.
Our ignorance of the future state of the market.
Precisely that. In a highly volatile, heavy-tailed system like crypto, our ability to predict the next state degrades rapidly. Salis entropy provides a nonlinear formula to quantify exactly how much disorder is in the system at any given second. But measuring the chaos is only half the battle. The network also has to absorb the damage, which brings in the concept of hysteresis.
Right, hysteresis. This is a phenomenon from physics where a system retains a memory of its past.
Yes.
Think of a physical metal paperclip. If you bend it slightly, the elasticity of the metal snaps it right back into its original shape.
Right, it recovers.
But if you apply extreme force and bend it entirely backward, past its yield point, it stays warped. Even when you remove the pressure, the metal has a physical memory of the trauma.
And applying hysteresis to the economy profoundly changes how we view recoveries. Traditional models assume that after a recession, the market acts like an elastic band, snapping back to its original equilibrium.
But it doesn't.
No. Hysteresis proves that severe macroeconomic shocks, like a massive crypto collapse or a global pandemic, permanently bend the metal of the economy.
Because you can't just unbankrupt a business when the crisis ends.
Exactly.
Supply chains are permanently severed. Consumer trust is fundamentally altered. The market doesn't bounce back. It structurally morphs. It retains the trauma of the levee flight.
This is the ultimate takeaway for anyone participating in modern financial systems. The era of assuming stationarity, the comforting belief that markets will always revert to a stable, predictable mean is over.
It's just gone.
You are navigating a nonlinear, multifractal network governed by heavy tails and historical trauma. In this environment, extreme volatility is not a temporary deviation. It is the operating environment.
Let's zoom out and look at the massive ground we've covered today.
We've covered a lot.
We started by throwing out the rational human actor, replacing them with bouncing gas molecules that naturally sift wealth into Pareto's asymmetrical power laws.
Right.
We mapped the infinite variance of Mandelbrot's levee flights, saw how zero-intelligence bots create self-organized stability, and traced the quantum entanglement of modern, traumatized crypto networks.
And the value of this deep dive is the analytical shortcut it provides. The next time the market experiences a catastrophic drop, the traditional instinct is to hunt for a micro-level narrative.
Like what the central bank did.
Or what a specific CEO tweeted. But econophysics trains you to look at the macro structure. You ask instead, how is the aggregate network transferring this kinetic energy? Where are the minimal spanning trees routing the contagion?
It totally elevates your perspective from the individual nodes to the entire living geometry of the ecosystem.
It does.
And before we close, we have to address one specific data point from the text regarding wealth redistribution, because the current kinetic models analyzing global exchange show that as competition increases in the network, the K index of inequality naturally pushes higher.
Yes.
The sources note it currently sits around 0.87, which mathematically means 13% of the population holds roughly 87% of the wealth.
And it is vital to present that metric exactly as the physical models derive it. The math of statistical mechanics points to this concentration happening independently of specific tax codes or political ideologies.
Right. It's just the math.
It's presented in the literature purely as a thermodynamic outcome of a highly competitive exchange environment with a zero-bound floor.
Which leaves us with a genuinely provocative thought for you to carry forward. We started by picturing the global economy as a sealed jar of hyperactive colliding gas molecules.
Right.
If extreme crushing wealth concentration is essentially a mathematical thermodynamic outcome of free exchange, just like gas inevitably settling into an uneven distribution in a jar. Does that mean economic inequality is fundamentally a law of physics rather than a failure of human policy?
It's a big question.
And if it is truly a law of physics, can we ever hope to fix it without fundamentally breaking the jar?